Hey everyone, welcome back to Corporate Decoder, the place where we try to unravel the mysteries behind those dense corporate filings. And let me tell you, this one about TG-17 Incorporated, aka Bond, is quite the ride. We're diving deep into a document that is packed with numbers, risks, and big plans. So, before we jump in, if you want more deep dives like this, make sure you hit that subscribe button and ring the bell. Also, we have a Discord community linked in the description below where we break down these filings together, so come join us. This company, Bond, is trying to make a splash with a new kind of personal security service, a preventative one using AI and actual security agents. They filed this S-1 document. Essentially a roadmap for going public, and it is stuffed with details about their financials, risks, and who is running the show. So let's decode it. First off, let's get a feel for the money. They've had a few funding rounds, raising quite a bit, but the story is they're not exactly swimming in profits yet. For the year that ended the 31st of December 2024, they had a net loss of $11,017,000, which is a decent chunk of change. This is a bit better than the previous year, 2023, where they lost $12,257,000. It seems they're trying to control those losses. The 9 months ending the 30th of September 2025 saw a net loss of $7,831,000. So the trend is still losses, but maybe a slight improvement, or at least not a runaway loss. When we look at their revenue for the year 2024, total revenue was $9,736,000. That is a pretty good jump of about 35% compared to 2023's revenue of $7,192,000. So while they are losing money, they are bringing in more money year over year, which is a positive sign. They're mainly making money from their B2B services, which is their business to business offerings, and then some from their cloud-based SaaS, which is software as a service. Their SaaS revenue is a pretty small slice of the pie, only about 14.7% in 2024. This indicates they're not just a tech company selling software, but also providing actual real-world security services. However, their costs are also growing. The cost of those revenues, meaning what it costs them to deliver those services, jumped from $6,086,000 in 2023 to $9,027,000 in 2024. That is a nearly 48% increase. This jump seems to be driven by their global expansion and their use of outsourced services to meet demand. When you look at the breakdown, their command center operations and security services are the big cost drivers. This means delivering actual human-powered security is expensive, and it is eating into their profits. All of this leads to a loss from operations. In 2024, this loss was $9,583,000, an increase from the previous year's $8,546,000 loss. So while revenue is up, their operating expenses have outpaced that growth, leading to a bigger operational loss. It is a classic startup challenge, balancing growth with profitability. Now, this next part is super important. It is called the stockholders deficit, and it is basically their net worth. As of the 31st of December 2024, their total stockholders deficit was $13,682,000. This means their liabilities, what they owe people, are much larger than their assets, what they own. It is a negative net worth, which is why they're considered a going concern, meaning there is doubt about their ability to keep operating without more money. They acknowledge this in the financial statement, saying there is a material uncertainty that may cast significant doubt on the company's ability to continue as a going concern. They plan to raise more capital, which is essential for survival. Let's talk about the folks steering this ship. Doran Kemple is the CEO and founder. He's got a heavy stake in the company, owning a massive chunk of the voting power. This makes the company a controlled company under NASDAQ rules. This means he has a lot of influence, which can be good if he is making smart decisions, but bad if you are an investor who wants more diversified leadership. Amit Hod, Joseph DeSalvo, and Michael Lambert are other key executives. Their salaries are listed, but what is more interesting is the stock options they've been granted. For example, Doran Kemple got a massive chunk of stock options in 2025, valued at over $2.5 million. These grants are a way to incentivize them, hoping they'll stick around and make the company successful. However, it also means potential dilution for existing shareholders when these options are exercised. Now, every company filing talks about risks, but Bond's list is quite extensive. They're worried about their technology needing constant updates, which is fair in the fast-paced tech world. Data security is a huge concern. If they get hacked, especially with all the personal information they handle, their reputation could be toast, leading to massive liabilities. They also mentioned privacy regulations are evolving, which can add costs and complexity. Relying on Amazon Web Services, or AWS, is another risk. Any disruption there could halt their services. Even insurance costs are a significant part of their expenses and subject to market fluctuations. They are also bracing for the costs of being a public company, which is substantial. International tariffs are also on their radar, as they could increase costs for their customers and indirectly affect Bond. A major risk they're highlighting is that this isn't a typical initial public offering, an IPO. It is a direct listing. This means no underwriters are buying shares up front to sell to the public. This can lead to more volatile stock prices and uncertain trading volumes right after they start trading on Nasdaq. There is also no guarantee that existing shareholders will even sell their shares, which could affect supply and demand. Plus, those shareholders can sell their shares pretty much any time, unlike in an IPO where there are often lockup periods. Speaking of trading, they expect to list on the Nasdaq under the symbol OBI, but there is a big catch. If Nasdaq doesn't approve their listing, this whole direct listing plan goes out the window, and even if they get listed, they're stressing that the market price of their common stock could be very volatile. They've had some private sales at prices like $1.087 per S-share, but that might have little to no relation to the actual public trading price. Here is a crucial point about the money. Bond itself isn't selling any stock. The shares being offered are from existing stockholders who want to sell their shares. This means Bond won't see any cash from these sales. Their plan is to use the money they've already raised and will raise in the future to fund operations. This filing lists out a lot of names, and that is because they need to disclose who is selling shares and how many. Ascent Partners Fund LLC is a big one, owning a massive number of shares that they plan to sell. Eastwood Fund Management LLC is another holder wanting to sell. It's interesting to see how many small investors are listed too, likely from their crowdfunding rounds, and they're collectively looking to sell a lot of shares. Bond is aiming to serve a huge market. They cite a report predicting the private security market will be worth over $338 billion by 2030. They believe their AI-driven preventative security is a new category, and they point out that billions of people have smartphones, the tech they rely on. Their strategy is to sell to corporations first, then expand to consumers. They even mention potential partnerships with insurance companies who might incentivize the use of their service. They project potentially reaching 100 million users and generating $5 billion in annual revenue in the next decade, which is ambitious. Bond claims to be the first and only company offering this kind of preventative pre-emergency personal security. They acknowledge competitors like Noonlight and Motorola Solutions for panic buttons, but argue those only handle emergencies and lack the preventative aspect and the AI-driven situational awareness Bond offers. They've invested heavily, over 350 engineering years, which they estimate at around $70 million into building their platform. This is a significant investment and barrier to entry, but they acknowledge that a company like Amazon could theoretically replicate their offerings. Looking at their cash situation as of the 30th of September 2025, they had about $925,000 in cash. But they had a working capital deficit of about $3.5 million. This means their short-term debts are higher than their accessible assets. They'll need substantial additional capital to keep going, which is why that equity line financing agreement with Ascent Partners Fund LLC for up to $300 million is so critical. This provides a potential lifeline, but it also carries a significant dilution risk for existing shareholders if they have to issue a lot of stock at a low price to raise funds. Their cash flow statements show a consistent pattern of negative cash flow from operating activities. For the 9 months ending the 30th of September 2025, they used $5,110,000 in operations. Financing activities brought in $5,432,000, showing their reliance on these funding rounds. Investing activities used a much smaller amount, just $18,000. This pattern of negative operating cash flow and reliance on financing is typical for growth companies, but it highlights the ongoing need for capital. So, what is my take on Bond? They're tackling a massive and relatable problem, personal safety. Their AI-powered preventative approach is innovative, and the idea of a 24/7 personal security companion is compelling. The substantial investment in R&D and their focus on building a scalable platform are strengths. However, the significant debt, the ongoing losses, and the reliance on future capital raises are serious concerns. The direct listing itself carries its own risks of volatility. The customer concentration is also a weak spot, with one customer making up a huge chunk of their revenue. The legal matters and the extensive list of risks detailed in the filing are not to be ignored either. It's a high-risk, potentially high-reward scenario. They have a unique product in a growing market, but the path to profitability looks long and requires careful execution and continued access to funding. Alright, that is our deep dive into TG-17 Incorporated, aka Bond's latest filing. What is your take on their preventative security model and their path to going public? Drop your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up. And don't forget to subscribe for more corporate decoding. And remember, join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you next time.